The second part of Chapter 8 takes us into option valuation. We're going to cover three methodologies: the binomial model, the Black-Scholes option pricing model, and put-call parity. Here's all the data for our sample stock option. To begin, we'll look at the binomial option pricing model as a lead-in to Black-Scholes. Note how the stock price is described. The current price is $27. It can only go up by a factor of 1.41 or down by 0.71. Those are the only two possible values at the end of 6 months, hence binomial. The exercise price is $25, risk-free rate 6%. Putting this into chart form adds the value of the option at both the up and down legs. Here's a zoomed view of the chart so you can more clearly see how the terminal stock and option values are computed. If the price goes up by a factor of 1.41, then the ending up price is $38.07 for a $13.07 payoff on the option. If down, the price is $19.17 and the payoff is 0. We're creating a portfolio by buying N sub S shares of stock and writing or selling one call option. We're creating a hedge portfolio, which will have the same payoff regardless of whether the stock price goes up or down. We're buying the N shares and selling a call, so the C, up or down, is negative. We need to find out how many shares we need to make the hedge work. So we set the up and down portfolio values equal and solve for N. In our example, N is equal to 0.6915. We'll zoom in on this chart on the next slide, but this expanded version from the mini-case Excel file includes all the given data and details how the hedge portfolio construction works. Given N equal to 0.6915, the ending value of both the up and the down portfolios is 1326. The ending values on both legs equal the value of the N shares of stock minus the option payoff. Here's the zoomed in version where you can see the end of leg calculations a bit better. We've succeeded in creating a hedge portfolio since both ending values are the same. If the payoff either way is 1326 at the end of 6 months, then the portfolio of stock and option is riskless, so the appropriate discount rate is the risk-free rate. So what's the PV of that payoff amount? Discounted at 6% per year for a half a year on a daily basis, today our portfolio would be worth $12.87. Alternately, we could just use the PV formula to arrive at the current value of $12.87. We now know the value of the portfolio at time 0. The portfolio is composed of the 0.6915 shares of stock and a written call. Rearranging the equation in the middle of the slide, we can solve for the current value of the call, and we'll see the calculations on the next slide. Our result, the call is currently worth about $5.80. We found the PV of the portfolio to be $12.87. We know the current price of the stock is $27, and we bought 0.6915 shares. So that value, 0.6915 times 27, $18.67. Subtracting the $12.87 yields the value of the call today, $5.80. We can modify our approach to valuing the option by creating what is called a replicating portfolio, because it's designed to replicate the call option's payoff. As you can see on the slide, the right-hand side of the equation is the replicating portfolio. In this case, we buy the N shares of stock and borrow an amount equal to the present value of the hedge portfolio's payoff, $12.87. If you borrow an amount equal to the present value of the hedge portfolio's riskless payoff and purchase N shares of stock, the portfolio's payoff will replicate the call option's payoff. If this is not true, then an arbitrage opportunity exists. Riskless arbitrage is a situation in which you have none of your own money invested and no risk, yet a positive cash flow. This continues the example showing that the net portfolio payoffs on both legs exactly match those of the option. Finishing up our example, if the option's price is not equal to the cost of the replicating portfolio, an arbitrage opportunity exists, and we'll see how that might work on the following slides. We found the option value to be $5.80. What if it's priced at $6? We create the replicating portfolio for a net gain of 20 cents. You borrowed to buy the stock, so none of your own money is invested. You have no risk since the payoffs to the replicating portfolio are equal whether the stock price moves up or down. You gain 20 cents. If you could do this with zero of your own money invested, you'd replicate it as much as possible, as fast as possible. This would create price pressure on the option, driving the price down to $5.80. We've only looked at a one-period binomial model for simplicity. The binomial model can be expanded to many periods, with the time periods reduced to very small increments. These are solved with a binomial lattice. The idea that a stock price can only take on two values may have seemed completely unrealistic, but consider, in a second, say, how much can a stock price move? A penny up or down? As the time period becomes smaller and smaller, the binomial option pricing model converges to the more widely used Black-Scholes option pricing model. The Black-Scholes option pricing model, like most theoretical models, is based on some strong underlying assumptions. An important one is that the stock pays no dividends during the life of the option. Since most dividends are paid quarterly and options are short-term instruments, this is not that unrealistic. But remember that after a theory is developed, assumptions are relaxed and the model tested again. There are versions of the Black-Scholes model that incorporate dividends paid. And as is usual, we assume away taxes and transaction costs. The Black-Scholes model also assumes that investors can borrow at the risk-free rate and that investors receive full proceeds from short selling, not the usual case. And another important limitation is that Black-Scholes values European options, those that can only be exercised at maturity. Most stock options in the United States are American in that they can be exercised at any time from purchase to expiration. Since the option to exercise at any time has value, we can assume that an American option is worth at least as much as a European one. Here's the formula to value a call option using the Black-Scholes option pricing model. While these look complicated, they're really not much more than plug and chug once you identify all the variables, which we'll do on the next slide. Note especially ND1 and E. ND1 requires either the use of an Excel function or a standard normal table, which is Appendix D in your book. E's value is shown here, and it's a key on your calculator, and there's an Excel function, EXP. We'll be using this because, as stated in the assumptions, the Black-Scholes model is a continuous model. Everything we've looked at relative to compounding and discounting so far has been discrete, but we'll be using continuous discounting in the Black-Scholes model. Note that for short-term instruments, we'll use a short-term risk-free rate, usually taken from the T-bill rates. The time to expiration T is expressed in years as a fraction. The natural log function is also available through an Excel function and as a key on your calculator. Sigma is the standard deviation of the rate of return on the stock underlying the option. And here's our sample data to value a call option. We'll see as we plug values into the formulas that it is more tedious than it is difficult. The first step is to compute D1. This is the calculation that requires the most care as there's so many components to it. If working in Excel, I strongly recommend computing each component separately and then combining them. Trying to do it all in one cell just offers too many opportunities for error, in order of operations if nothing else, and the placement of parentheses. We found D1, 0.4819. From D1, we find D2, 0.1355. Given those values, we can use the tables, but probably not, or the Excel function, which we've done here. Note that Excel has two normal functions. Norm SDIST finds the value for a standard normal distribution. With the norm DIST function, no S in the middle, you have to specify the mean and variance, which are taken as 0 and 1 for standard normal. We're ready to plug to the main equation. Here's where continuous discounting comes into play. The term XE raised to the minus RT is the continuous version of discounting X at the risk-free rate for time T. Using our given values, we find the value of the call as $5.06. There's a video tutorial covering the calculation of a call price posted with this unit. Now that we've seen and worked through the Black-Scholes model, let's look at how each of the variables impacts the call option's value. Obviously, as the stock price rises, so does the value of a call on that stock. As the strike price increases, however, the value of the call decreases. A call with a strike price of $25 is worth more than one with a strike price of $35. Remember that time has value, so as the time to expiration increases, so does the value of the option. More time for the stock price to end up in the money. As the risk-free rate increases, it decreases the discounted value of the exercise price, which increases the value of the call option. The last one is important. As the variance of the returns on the underlying stock increases, so does the value of the option. This is completely opposite to the impact on the value of a share of stock, where volatility is a negative. The reason is that higher variance increases the probability of the stock price rising, and with a call option, there's no downside. While we focused on call options, we need to at least take a look at put options to understand both types. A put gives the holder the right to sell an asset. You might use this in a protective put strategy. Suppose you're concerned that the price of a stock you own may go down, but you don't want to sell it. You could buy put with a strike price slightly below where the stock is trading. The price falls, you exercise and limit your loss. Price doesn't fall, you lose the premium you paid, something like insurance. Put-call parity specifies the relationship between a put, a call, and the underlying stock price. For our example, assume we create two portfolios. In one, you hold a put option and a share of stock. In the other, you hold a call option and the present value of the exercise price. You'll see how this works on the next slide. This table shows the value of each portfolio at expiration, when the ending stock price is above and below the exercise price. Note the results. In both cases, the value of the two portfolios is the same. If the payoffs are equal, the portfolios must be equal, which leads to put-call parity. Put-call parity can be used to solve for the value of a put given the other variables. This ends our coverage of options and of Unit E.